Right now, most Australians investing in the share market are doing it completely wrong. Not because they picked bad stocks, because they never understood which type of company actually builds wealth in 2026, and which ones quietly drain it. And with interest rates finally shifting, inflation cooling, and the ASX sitting at levels that have not been seen in years, the window you are looking at right now is one of the most important investing moments of the last decade. Miss it and you will spend the next 5 years watching other people's portfolios do what yours should have. So today, I am breaking down the best companies to invest in on the Australian and global share market in 2026. Not opinions. Not hype. Strategy backed by earnings data, sector momentum, and where the smart money is actually flowing right now. And I am going to show you exactly how to think about each one based on where you are in your investing journey. But first, the number you need to hear. The ASX 200 has delivered an average annual return of around 10% including dividends over the long run. But that average hides a brutal truth. The top 20% of stocks drive almost all of that return. The bottom 80% are essentially noise. So picking the right company is not just about doing better. It is the difference between building real wealth and running on a treadmill for 20 years. Let us start with the sector that almost every serious investor in Australia has exposure to right now. Banks. The Big Four, Commonwealth Bank, Westpac, ANZ, and NAB, are not exciting. But they are machines. CBA in particular has held its position as one of the most profitable retail banks in the developed world. Its return on equity sits consistently above 13%. Its dividend yield is around 3.5% fully franked. And for Australian investors, those franking credits are pure gold. A 3.5% yield with full franking credits is effectively closer to 5% in your hand once you factor in the tax offset. In a low excitement, high reliability play, CBA remains the benchmark. But here is the honest catch. CBA is expensive. Its price-to-earnings ratio is trading well above its historical average. You are paying a premium for certainty. That is fine if your time horizon is 10+ years. It is a problem if you are expecting a quick gain. Now let us move to the sector with the most momentum in 2026. Technology and artificial intelligence infrastructure. Globally, the story is still being written. But the companies supplying the picks and shovels of the AI gold rush are the ones printing money. Nvidia remains the most talked about name, and for good reason. Its data center revenue has compounded at a rate that few companies in history have matched. But at current valuations, you are already paying for the next 3 years of growth. The smarter play for Australian investors looking at global tech exposure is through a diversified ETF like the Nasdaq 100 via the NDQ ETF on the ASX. You get the upside of the AI infrastructure build-out without betting everything on a single name. Diversified. Low cost. Tax efficient inside super. On the ASX itself, keep your eye on WiseTech Global. It is not cheap, but it is one of the few Australian tech companies with genuine global pricing power. Its CargoWise platform is deeply embedded in global logistics. Switching costs are enormous. Revenue is recurring. And the total addressable market is still largely untapped. For patient investors, WiseTech is the kind of company that rewards people who hold through the boring patches. Next, resources. And this one is more nuanced in 2026 than it has been in years. BHP remains the default for Australian investors wanting commodity exposure. Iron ore is still its backbone, and China's infrastructure cycle, while slower than its peak, has not collapsed the way some predicted. BHP also has a growing copper business, and copper is the metal of the energy transition. Every electric vehicle, every solar panel, every grid upgrade needs it. Long-term, copper demand is structural. BHP gives you exposure to both the old economy and the new one inside a single stock with a strong dividend history. But do not sleep on Pilbara Minerals if you have a higher risk tolerance and a longer time frame. Lithium prices have been hammered over the last 18 months. Pilbara has pulled back hard from its highs. But the underlying demand story for lithium has not changed. It has just been delayed. Battery storage, electric vehicles, and grid infrastructure all need lithium at scale. Buying quality resource companies when the cycle is down is exactly how long-term wealth is built in this sector. Now let us talk about the category most Australians ignore completely. Healthcare. CSL is one of the greatest companies Australia has ever produced. It operates in a global duopoly for plasma-derived therapies. Its products are not discretionary. People need them to survive. Revenue is defensive. Margins are strong. And its pipeline of next-generation therapies means the growth runway is long. CSL is the kind of stock you buy, hold, and stop looking at for 5 years. When you check back, you will almost always be glad you did. Here is the framework for putting this all together. You are in the early accumulation phase, net worth under $250,000, do not stock pick. Build your base through low-cost broad ETFs. The Vanguard Australian Shares ETF and a global index fund give you exposure to all of these companies without the concentration risk of picking wrong. Let the market do the work while you focus on earning more and contributing consistently. If you are in the optimization phase, net worth between $250,000 and $1 million, you can start tilting your portfolio towards specific sectors. Overweight healthcare and technology for growth. Keep your bank exposure for franking credit income. Consider your super asset allocation as part of the whole picture, not separate from it. If you are in the wealth preservation phase, above $1 million, capital protection matters as much as growth. Quality over momentum. Companies with pricing power, strong balance sheets, and recurring revenue. CSL, CBA, and global tech via ETFs form the core. Everything else is a satellite position sized carefully. Here is what you can do today. Look at your current portfolio or your super investment option and ask yourself one honest question. Am I invested in companies with real earnings, real pricing power, and real long-term demand? Or am I holding names I picked based on a headline 2 years ago? Because the Australians who build serious wealth through the share market are not the ones who find the next big thing. They are the ones who own the right things consistently, reinvest every dividend, and never panic when the market drops 15% and the news tells them the world is ending. The market rewards patience and punishes emotion. Every single time. If this video gave you a clearer picture of where to put your money in 2026, hit the like button and subscribe. Turn on notifications so you do not miss the next one. I will see you there.